tension built up in the gold price for a very long time. The circumstance continued, it got worse, it continued, it got worse, it continued, it got worse, nothing happened. And even when it moved, it didn't move because Americans were concerned about the deterioration in the purchasing price of the US dollar. It moved because the US government gave foreign central banks no choice.
You're watching Silver News Daily. Subscribe for more.
Silver and gold have already begun to move, and most people watching the market think they understand why. They point to inflation, they point to interest rates, they point to geopolitical tension. But according to legendary resource investor Rick Rule, almost everyone is looking in the wrong direction. Because the rally we just witnessed wasn't really driven by the public at all. It wasn't even driven by the kind of investors who normally dominate these markets. The real force behind the move is something much deeper, something that has been quietly building for years beneath the surface of the global financial system. Think about what we've been living through over the last decade. Government debt exploding to levels that would have been unimaginable just a generation ago. Central banks printing trillions of dollars, euros, and yen in an attempt to hold the entire financial system together. And all the while, currencies slowly losing purchasing power while most people remain completely unaware of what is happening to their savings. For years, these pressures were building in the background, like tension inside a massive spring being compressed tighter and tighter. And yet the strange thing is that the gold price barely reacted for a long time. The fiscal situation kept getting worse. Debt kept growing. Governments kept spending far beyond their means. But the price of gold and silver seemed almost indifferent. It was as if the market refused to acknowledge the reality that the monetary system itself was becoming increasingly unstable. That disconnect confused many investors because logically the metals should have been moving much earlier. Rick Rule explains that this long period of silence was actually the calm before the storm. The tension inside the gold market had been building for years without release. The underlying conditions kept deteriorating, but the price remained relatively restrained, creating a massive imbalance between reality and perception. When markets behave like this, they often store enormous energy beneath the surface. And when that energy finally releases, the move can be far more violent than anyone expects. What makes this moment even more fascinating is that the recent rally wasn't triggered by the usual crowd of retail investors rushing into precious metals. In fact, most ordinary investors still have almost no exposure to gold or silver today. The mainstream financial world is still focused on stocks, bonds, technology companies, and speculative growth assets. Precious metals remain a tiny corner of the investment universe, often ignored or dismissed as outdated relics. That means something very unusual is happening right now. The price has already begun to move before the majority of investors have even entered the market. And historically, when a bull market in precious metals begins before the crowd arrives, it can signal that the real move is still ahead. Because once the broader investing public finally recognizes what is happening, the flow of capital into a relatively small market like silver can become explosive. And this is where Rick Rule's warning becomes incredibly important. The rally we've seen so far may only be the early phase of a much larger shift. A shift not just in the metals market, but in the way the world stores wealth and protects purchasing power. The forces driving gold higher today are not temporary news headlines or short-term speculation. They are structural changes happening inside the global financial system itself. So the real question isn't simply why gold and silver have already begun to rally. The real question is what happens when the rest of the world finally understands why. Because if the current trend continues, the next phase of this move could look very different from anything we've seen before. And once silver finally joins the move in full force, the price projections that sound unbelievable today might start to look a lot less like fantasy and a lot more like reality.
Year. And I think if your expectations are for the future are set by the immediate past, you're going to disappoint yourself. I think we'll do well in the precious metal space for maybe as much as 10 years, but at least 5. Because I think doing well in the precious metal space, unfortunately, means that the purchasing power of the rest of our savings is going to fall. We've talked about the arithmetic of America before, so you understand what I'm thinking. What happens is that when people buy that narrative, when they buy the whole narrative around precious metals, and they get conditioned to see the response to that narrative being 100% annualized gains, if they get 10 or 12, they're disappointed, which is really stupid. If you had gotten 10 or 12% gains in 2020 or 2021, you would have been pleased as punch. So the problem in terms of understanding the market that's ahead of us isn't the market itself, but rather people's perception of it. I think we're going to have, we may have a flat year in 2026. That doesn't matter much to me, to be honest with you. I'm old enough that I don't require immediate gratification. I think the move that we saw last year is important to put in context too, Donegan. I think the move that we saw last year was rear-looking, not forward-looking, in the sense that everything that was true at the beginning of 2025 with regards to the deteriorating fiscal condition of Western governments, but especially the U.S. government, was true in 2017 and true in 2018. But there was no price response. People looked at the circumstance through the lens of experience that went back to 2082. In other words, people were rear-looking rather than forward-looking. And so tension built up in the gold price for a very long time. The circumstance continued, it got worse, it continued, it got worse, it continued, it got worse. Nothing happened.
And just before we get going, we just launched the official Silver News Daily Telegram. To kick things off, we're running a 10-ounce silver giveaway. Yes, real physical silver, not a voucher, not digital credits, actual bullion. This Telegram will be our new home for real-time silver discussions, market insights, collection picks, and everything precious metals. It's where the community truly comes alive. Here's how to enter the 10-ounce silver giveaway. Be subscribed to Silver News Daily on YouTube. Turn on the notification bell. Comment 10-ounce giveaway on 3 separate videos. Be an active member of the Telegram group and say hi. Once we hit 500 active Telegram members, we'll pick one lucky winner to receive 10 ounces of silver shipped directly to you. So get in early, stay active.
Even when it moved, it didn't move because Americans were concerned about the deterioration in the purchasing price of the U.S. dollar. It moved because the U.S. government gave foreign central banks no choice but to save in gold away from the U.S. dollar. What that tells me is that the real natural buyer for gold mostly isn't in the trade yet. I mean, yes, the people who were clients of mine before I ostensibly retired, and the people who are listeners to you, our crew, are excited by what's happening in gold, and they believe in gold. But you live in Florida. It's like if you went to a rural Pentecostal church in Florida and asked the choir if they believe in God. You're going to get an affirmative response. But most people aren't in the gold trade yet, which tells me that gold has further to go. Now, it may be that the adherents, it may be that choir's out of breath, and there's no move in the gold price for 2026. But the whole set of circumstances that propelled gold is very much intact. So the trade is very much intact. What's important to note is the second part of your question, I think, for those of us who care about the trade, which is to say that if the gold price doesn't go up from here, or the silver price doesn't go up from here for a year, there's still room to run the stocks, because Wall Street's calculation and Bay Street's calculation on the value of these companies is predicated on $3,500 gold and $45 silver. Now, if your earnings estimates are based on $3,500 and you're selling the gold for $5,000, it's kind of hard not to get a surprise. And if you redo your net present value calculations of future cash flows of $5,000, up from 33, 34, 35, you're going to have some positive surprises. Same thing in the silver market. When I look at the Bay Street earnings forecasts and the Wall Street earnings forecasts, they're using $45 silver. If you revalue these things at, say, silver price, you get a much higher number. So I suspect, particularly with regards to the senior silver producers, that if I see a sideways movement in silver for 12 months, I see stocks that have 50% to run on a valuation basis alone. pretty attractive. I'm not saying that's going to happen because sometimes narrative trails arithmetic, but I'm an investor that's all about arithmetic. So I'm feeling fairly sanguine about things.
For years, the gold market looked almost asleep. Governments were accumulating debt at a staggering pace, deficits were expanding, and central banks were creating money on a scale that would have shocked previous generations. Logically, many investors expected gold to react immediately to these conditions. After all, gold has always served as the ultimate financial barometer when confidence in paper currencies begins to erode. Yet strangely, despite all of these warning signs, the gold price remained relatively restrained for a very long time. Rick Rule points out that this apparent calm created one of the most important setups in modern precious metals history, because while the price looked quiet on the surface, the underlying pressure inside the market was steadily building. Year after year, the fiscal situation in Western economies deteriorated further. Government spending continued to outpace revenue, national debts climbed into the tens of trillions, and the long-term promises made by governments through entitlement programs became larger than the economies supporting them. None of these trends were temporary. They were structural. The arithmetic simply stopped working. And yet the market took an incredibly long time to fully respond to this reality. Investors were still looking backwards instead of forwards. They were interpreting the economic environment through the lens of past crises rather than recognizing that the current situation was fundamentally different. Many assumed that the system would stabilize just as it had after previous recessions, so they remained comfortable holding traditional financial assets. But every year that passed without a real solution only made the imbalance worse. The tension continued to build beneath the surface of the gold market. The conditions that normally drive gold higher were not only present, they were intensifying. And the longer that pressure remained trapped without a price response, the more powerful the eventual breakout was likely to become. Eventually, something had to give. Markets cannot ignore economic reality forever. When the move finally began, it caught many people by surprise because they had grown used to gold's long period of relative stability. But what they were witnessing was not a sudden change in circumstances. It was the delayed reaction to years of accumulating pressure inside the global financial system. Rick Rule describes this perfectly when he explains that the rally we saw was largely rear-looking rather than forward-looking. In other words, the price movement was not predicting a new crisis that suddenly appeared. It was the market finally acknowledging conditions that had already existed for years. The deteriorating fiscal position of governments had been visible long before the breakout occurred, but it simply took time for that reality to be fully reflected in the price of gold. And this is a crucial point for understanding what may come next, because if the move we've already seen was simply the market catching up to the problems that already existed, then the real question becomes what happens when investors start pricing in the problems that are still ahead.
Than it is today, too. Note something else. The market share of central banks' holdings of gold had fallen substantially. So there's competition for gold in the market now. To the extent that the retail buyer, the private buyer, comes into the gold market, there is still substantial central bank buying. So there's two classifications of buyer now. All of that's bullish. Investor behavior, however, which is sort of what that chart is about, isn't as important to me because in the near term it's shaped by narrative. Then investor motivation. Investor motivation, I think, will be shaped by the deterioration of purchasing power in fiat currency denominated instruments. I think that's really important. In other words, the narrative will follow the incentive. And the incentives, debt and deficits, quantitative easing, unfunded entitlement promises, the slow realization that people have that their savings and salaries are not keeping pace with the deterioration of the US dollar and that they need to change their savings matrix to protect their capital. I laugh. It's tragic for most people. But that's going to have dramatic impact. You know, when I say, I need to be better about how I communicate this. When I say in the abstract that I believe the purchasing power of the US dollar declines by 75%, people nod sagely and then, go on about their day. What I need to say is that a pensioner who is living today on $4,000 a month will require $16,000 a month to maintain the same standard of living 10 years from now. And where will that extra $12,000 come from? When people personalize it like that, when people understand that if they're getting paid 4% on their savings in a currency where the purchasing power is declining by 4% a year, what's happening is they're losing half their savings rather than making 4%. People need to personalize this. Whether or not they buy gold is of less interest to me, frankly, than whether they understand that they are responsible for their future and their children's future. Their community isn't, their government is.
But here's where Rick Rule introduces an insight that completely changes the way most people interpret the rally. Because while many analysts assumed the move was driven by inflation fears in the United States or retail investors rushing into precious metals, the real trigger came from somewhere else entirely. The force that truly pushed gold higher wasn't the public. It wasn't even the typical investment crowd that normally dominates these markets. It was foreign central banks. For decades, the global financial system has revolved around one central pillar, the U.S. dollar. Countries around the world accumulated massive reserves of dollar-denominated assets, primarily U.S. Treasury bonds. These reserves acted as the foundation of international trade and financial stability. But in recent years, something began to change. Governments and central banks outside the United States started questioning whether holding the majority of their savings in another country's currency was still safe. Rick Rule explains that the policies of the U.S. government unintentionally accelerated this shift. When sanctions began to freeze foreign reserves and restrict access to dollar-based systems, many countries realized something important. Their savings could be politically vulnerable. Assets they believed were secure could suddenly become inaccessible if geopolitical tensions escalated. And when that realization spread through central banks, it created a powerful incentive to diversify away from the dollar. Gold became the natural alternative. Unlike currencies or government bonds, gold carries no counterparty risk. It cannot be printed by another government, and it cannot be frozen by a foreign banking system. For central banks looking to protect their national reserves, gold offered something that paper assets could not guarantee: independence. As a result, many central banks began quietly increasing their gold purchases, shifting part of their reserves out of dollar-based assets and into physical metal. This shift may sound subtle, but its impact on the market was enormous. Central banks control vast pools of capital, and when even a small portion of those reserves begins moving into gold, it creates a powerful source of demand. According to Rick Rule, this was the real catalyst behind the rally. Gold didn't rise simply because investors were worried about inflation. It rose because foreign governments were being pushed toward gold as a strategic reserve asset. And here's the remarkable part. While this massive shift was happening at the institutional level, most ordinary investors barely noticed. The mainstream investment world was still largely absent from the gold market. The people who traditionally drive speculative rallies in precious metals were still focused on other assets, which means the early phase of this move may have already begun without the participation of the broader public. And historically, that kind of setup can be extremely powerful, because once the retail investment crowd finally recognizes the trend, the second phase of a precious metals bull market can unfold much faster than the first.
Franz Pick, when he described them as certificates of guaranteed confiscation. If you buy a 30-year bond yielding 5.2, and your purchasing power is declining by 8 to 10% compounded, when the market begins to realize that there's a negative real interest rate, the capital value of the bond declines at the same time that the purchasing power of the yield and the stored principal declines. And that changes that graph really substantially. Really substantially. Imagine for a second that rather than being a gold dealer and a podcast host, that you were running the University of Florida endowment, and you were responsible for investing the endowment of the University of Florida for the benefit of the institution and hopefully its students 30 years from now. And don't say quit. Don't say I quit. Imagine that you inherited a portfolio that was 65% long bonds because they were riskless. And imagine that you suddenly woke up at 2 o'clock in the morning and said, wait a minute. In 30 years, the purchasing power represented by the principal in that bond has declined by 80%. Dunnigan now has to do something. And I think that's the realization that people are coming to. Their fondness for long-dated treasuries is a relic of the period 1982 to 2022, where the U.S. dollar was strong, where real and nominal interest rates were falling. And in 2022, and you saw that on that chart, the world changed. And it changed in a way that changes the composition of asset responses to crises. I would argue in favor of gold. The only thing that would change my mind would be a real default, which is to say a deflationary circumstance. And I, in my lifetime, have watched the fiscal response to deflationary pressures as always having been printing.
But here's the surprising part of Rick Rule's argument. Even after the rally we've already seen, the vast majority of investors still haven't entered the precious metals market. In fact, gold and silver remain some of the most underowned assets in the entire financial system. When you step back and look at the global investment landscape, trillions of dollars sit inside stocks, bonds, real estate, and speculative technology sectors. Precious metals, by comparison, represent only a tiny fraction of global portfolios. Rick Rule often illustrates this with a simple analogy. When you speak with people who already follow the precious metals market, it can feel like everyone believes in gold and silver. But that's because you're talking to the choir. It's like walking into a church and asking the congregation whether they believe in God. Of course they do. But outside that room, the majority of the world isn't paying attention at all. And that's exactly where the metals market stands today. The people who already believe in gold are excited about the rally. They follow every price movement, every central bank purchase, every macroeconomic signal. But when you zoom out and look at the broader investing public, the participation simply isn't there yet. Most financial advisors still allocate almost nothing to precious metals. Pension funds barely touch the sector. Retail investors are still overwhelmingly concentrated in equities and traditional financial products. This matters enormously because bull markets in precious metals tend to unfold in stages. The early stage is usually driven by a small group of investors who understand the underlying macroeconomic pressures. They begin accumulating quietly while the rest of the market remains skeptical. That phase appears to be exactly where we are now. The second phase is where things begin to accelerate. This is when institutional investors, portfolio managers, and large funds begin adjusting their allocations. Even a small shift in portfolio percentages can create massive inflows into the metals market because the overall pool of capital is so large. If major funds move from zero exposure to even a 1 or 2% allocation, the demand shock can be enormous. But the final phase is where the real fireworks tend to happen. That's when the broader public finally notice what's going on. Media headlines begin highlighting rising prices. Financial commentators start discussing precious metals again. And suddenly millions of investors who ignored the sector for years begin scrambling to gain exposure. Rick Rule believes we're still a long way from that final phase. The majority of investors simply haven't entered the trade yet. And paradoxically, that's exactly what makes the long-term outlook for gold and silver so compelling. Because when an asset class begins rising before the crowd arrives, it often means the biggest part of the move is still ahead.
Have had their opinion of the immediate future shaped by their experience in the immediate past. And their experience in the immediate past has been, thou shalt not rock the boat. We saw this. I was too young to understand it, but I understand it now historically. We saw this in the period 1968 to 1982. There were 5 years when the writing was on the wall for the U.S. dollar and the U.S. Budget. You know, we fought the war in Vietnam, which we lost. We fought the war in poverty, which we lost. We had the bills left over. Circumstance very much like today. And price levels in the United States were running substantially higher than government estimates of inflation. And they were running substantially higher than the then controlled interest rates. And nobody cared much. I mean, yes, they had little buttons that said whip inflation now. I don't know if you remember Gerald Ford. You know, all those morons. But nobody was really paying attention until they did. And when they did, beginning in 1972, they began to worry in earnest. Now, in 1975, Congress actually took action. They raised the interest rate. And when they raised the interest rate precipitously. When they did that, they cut the price of gold in half in 9 months. They also obliterated the U.S. long bond market, obliterated the equity market, and kicked the housing market in the cojones. And in 9 months, they lost their courage. They cut the interest rate again, printed, and what Congress did is they announced to the world that their reelection was more important than the sanctity of the U.S. dollar. And that time, the world had 5 years preparation, and gold went on a real romp. Gold went from $100 at the end of 1975 to $850 by the end of 1981. It was a hell of a romp. I think past is probably prologue. I think over time, the portfolio managers get ambushed by reality, much as they did in 1972 and 1973. And then I think you're going to see a fairly dramatic response.
Now, if you extend this line of thinking, you begin to understand why Rick Rule believes the precious metals market could remain strong not just for a few months or a single year, but potentially for an entire decade. Because the forces pushing gold higher are not short-term events. They are structural problems embedded deep within the global financial system, and those problems are not being solved. In many ways, they are actually getting worse. At the center of this issue is the declining purchasing power of fiat currencies. Governments around the world have built economic systems that rely heavily on debt expansion. Every year, new borrowing is required simply to keep the system functioning. Interest payments on national debt continue to rise, and political realities make meaningful spending reductions extremely difficult. When governments are trapped in this kind of cycle, the most common solution is currency debasement. Not always openly and not always dramatically, but slowly and consistently through inflation and monetary expansion. Rick Rule has often referred to this as a simple arithmetic problem. The promises made by governments, especially in large Western economies, are far greater than the resources available to fulfill them. Entitlement programs, healthcare commitments, pension obligations, and defense spending all continue to grow, while tax revenues cannot keep pace without damaging economic growth. The gap between promises and reality keeps widening, and when that happens, governments tend to rely on monetary policy to bridge the difference. The consequence of this process is subtle but powerful. Over time, the purchasing power of savings held in fiat currency slowly erodes. People may not notice it immediately because the process unfolds gradually, but year after year, the same amount of money buys less. What gold and silver represent in this environment is not simply speculation or profit potential. They represent protection against the erosion of currency value. And this is why Rick Rule believes precious metals could remain in a favorable environment for many years. Because as long as governments continue expanding debt and deficits, the incentive to hold real assets instead of purely financial ones becomes stronger. Precious metals perform well not because everything is going right in the financial system, but because something fundamental is going wrong. Ironically, strong performance in gold and silver is often a signal that the broader financial environment is becoming more unstable. When metals rise steadily over long periods, it usually reflects declining confidence in the purchasing power of traditional savings. Rick Rule openly acknowledges this uncomfortable reality. Doing well in precious metals often means that the rest of the financial system is struggling with deep structural imbalances. And if those imbalances continue to grow, which current trends strongly suggest they will, then the environment that supports higher gold and silver prices may remain in place far longer than most investors expect.
The analyst reports, both in terms of their earnings forecasts and the net present value calculations, are predicated on sharply lower precious metals prices. If the precious metals prices trade sideways for a year, it would suggest that valuations can move higher. The consensus metals prices on Wall Street and Bay Street around gold seem to cluster in the $3,200 to $3,500 an ounce range. Now, it seems to me if you make the stuff if you sell the stuff for $5,000 and your earnings forecast is based on $3,500, that arithmetically you're pretty likely to surprise folks, and the surprise is likely to be good. Similarly, if you're doing a net asset value calculation of future cash flows and discounting them back at Wall Street's prevailing 5% discount rate, and you're using a $3,500 denominator, which is to say a $3,500 gold price in a $5,000 world, that you are understating the value of that company fairly substantially. If the gold price doesn't fall fairly substantially, it would seem to me that the good guys, the real producers, revalue very, very substantially just to reflect the current reality of this gold and silver price, not to anticipate higher prices. I was fairly public a few weeks ago about selling 80% of my physical silver. I did it for two reasons. I did it because silver occupied a speculative position in my portfolio. Gold for me is a savings asset. Silver was a speculation. I bought silver because it was hated. You'll recall, Dunnigan, in our earlier interviews, when I described silver as a coiled spring, that when the hate dissipated, it would be easy for the price to double. Well, it didn't double. It went up fivefold, sixfold. When that happened, the reason that I owned my silver went away. I owned it as a speculation. And I had to decide, was it still the best speculation in my portfolio relative to the amount of capital I had tied up, or was there something better to do with it? And I decided for half the money that was in my silver portfolio that I'd rather buy the silver stocks. Because if silver didn't go up anymore, by definition, I couldn't make any money. If silver did go up, the silver stocks would go up too. But if silver just went sideways, the silver stocks would go up by 50%. That seemed like a better speculation to me. For me, it's all about arithmetic. Ironically, if the price of silver fell, while the price of the silver stocks would fall, the values wouldn't need to fall very much because the net present value assumptions were made at a $45 silver price. So if the price of silver fell from 80 to 50, that's still above the consensus silver price that people have used to calculate those net present values. So it seemed to me like I had a better speculation in the silver stocks than the silver. Now, for me, gold is a very different circumstance. I save in gold. So 25% of the capital that I drew out of the sale of 80% of my physical silver went into physical gold. Because I wanted to take some of my speculative gains all the way off the table and get them out of harm's way. And as you know, Dunnigan, since the year 2000, I've maintained liquidity in US dollars, but I've saved in gold. I regard them personally for myself as very different assets or asset classes. I don't know how your customer.
But here's where Rick Rule believes many investors fall into a psychological trap that can cause them to completely misunderstand the opportunity in precious metals. Because once a rally finally begins, people quickly become conditioned to expect explosive gains every single year. And when those gains slow down even slightly, they assume the opportunity is over. Think about how markets behave after a big move. If gold or silver rises sharply in one year, investors begin anchoring their expectations to that recent performance. Suddenly, anything less than dramatic price surges starts to feel disappointing. A 10% or 12% annual gain, which would normally be considered an outstanding return in most asset classes, suddenly feels insignificant to investors who are hoping for triple-digit moves. Rick Rule points out how irrational this mindset can be. If investors had been offered steady 10 to 12% returns in many traditional markets during difficult economic years, like 2020 or 2021, they would have been thrilled. Yet when precious metals deliver that same type of performance, some people dismiss it because they are expecting spectacular explosions every year. The reality is that strong bull markets often unfold gradually, with periods of consolidation between major advances. This psychological bias can cause investors to abandon positions at exactly the wrong time. If gold or silver spends a year moving sideways, many people assume the rally has ended. But experienced resource investors understand that these quiet periods are often necessary for the market to digest previous gains and prepare for the next phase of the move. In long-term commodity cycles, patience is not just helpful, it's essential. Rick Rule himself has often emphasized that he no longer requires immediate gratification from his investments. The most powerful wealth-building opportunities rarely unfold overnight. They develop over years as underlying economic forces continue pushing the trend forward. Investors who expect instant results often miss the larger move because they lose confidence during the quieter phases of the cycle. And this perspective becomes even more important when we shift our attention towards silver. Because while gold often moves in steady, deliberate trends, silver has a very different personality. Silver tends to remain quiet for long periods, frustrating investors who expect constant momentum. But when the metal finally begins moving in earnest, the gains can arrive with astonishing speed. Which brings us to the next critical piece of this puzzle. If gold has already begun responding to the pressures building inside the financial system, history suggests that silver may eventually follow the same path, but with far greater intensity.
And real tokenized gold and silver appears when they are delivery receipts that are housed in institutions like Brinks that are publicly traded or in the Royal Canadian Mint. My belief is that the technology will exist so that Battle Bank can charge against gold tokens. Right now, the only form of security that I feel comfortable with my customers having in their own accounts are not tokenized metal, but rather metal itself. With the technology that exists today and the regulatory climate that we have today, even the tether instrument, which is fairly liquid, doesn't work for me. I want my repository to be surrounded by a body of precedent and a body of law that I know my rights. And I don't want my security housed in a wallet that could be hacked. So given the current state of technology, I want my collateral. Listen, I own gold and silver, gold in particular, because I want to worry less, not worry more. And the idea that I would superimpose another level of worry is not something I'm interested in. I believe 2 years from now, 2.5 years from now, the technology exists today, but I believe the regulatory protocols will exist that will have a coin that is a securitized depository receipt housed in a depository institution that I can trust. Even Tether, I know these guys. I have a high degree of regard for them. They house their gold and silver in a private vault in Switzerland. They don't share the audit results with me. The vault isn't in a publicly traded company. I don't think publicly traded companies are superior, but in a publicly traded company, I can see the income statement and the balance sheet on a quarterly basis. In other words, I know that my vault will continue to be in business and that the steward of my gold and silver won't be a bankruptcy court somewhere. I'm very picky. I'm very picky about how I store my savings, and I'm very picky about my collateral. And right now, my collateral has to be physical metal with an established precedent, an established body of law, and it has to be in a facility where I know, if not love and trust, the fiduciary. If the owner of a private vault lies to me, I can sue that person. I can prosecute him for fraud. If Brinks lies to the SEC in a filing statement, that's a felony. It's not Rick Rules beef. It's Brinks v. the SEC. And that's important to me. I do not own gold to increase my risk.
This brings us to silver. And historically, this is where things start to get very interesting, because while gold tends to move first in precious metals bull markets, silver is the metal that often delivers the most dramatic moves once momentum begins to build. Time and time again throughout financial history, we've seen the same pattern unfold. Gold starts rising quietly as institutional investors and central banks begin adjusting their positions. The move is steady, sometimes even slow, and for a while it barely attracts mainstream attention. But then silver wakes up, and when it does, the pace of the rally can change completely. Silver has always behaved like gold's more volatile counterpart. It shares the same monetary history, the same role as a store of value, and the same protection against currency debasement. But unlike gold, silver also sits at the center of a wide range of industrial applications. It is used in electronics, solar panels, electric vehicles, medical equipment, and advanced technologies that continue expanding every year. This dual identity means silver responds to two powerful forces at the same time: monetary demand and industrial demand. During quiet economic periods, that combination can keep silver prices relatively restrained. But when investment demand suddenly increases, the market can become extremely tight very quickly. The total size of the silver market is much smaller than the gold market, which means it takes far less capital to move the price dramatically. When new investment flows arrive, the supply available to absorb that demand can disappear much faster than most investors expect. And this is exactly why silver has developed a reputation for explosive bull market behavior. In previous cycles, the metal has remained frustratingly quiet for years while gold gradually climbed higher. Many investors became impatient and assumed silver would never move. But once momentum finally arrived, the metal surged with astonishing speed. In the late 1970s, silver ran from just a few dollars to nearly $50 in a very short period of time. Then again, in the 2000s bull market, silver climbed from under $10 to almost $50 by 2011. These types of moves are not typical in most financial markets, but they are surprisingly common in silver once the conditions align. And if the forces Rick Rule is describing continue to strengthen, currency debasement, central bank demand for hard assets, and growing investor awareness, then silver may eventually enter the phase of the cycle where it begins catching up to gold. The key point here is that silver rarely moves gradually once the market fully wakes up. It tends to move in bursts, long periods of calm followed by rapid advances that surprise even experienced investors. Which means that while the early stages of the precious metals bull market may appear quiet and uneventful, the later stages can unfold far more dramatically than most people are prepared for.
Way, way safer right now. There's a second thing, too, that probably interests you, Dunnigan, which is to say that there's a lot of physical gold holders who won't make the switch because of capital gains tax. Think about an old, fat, cranky, bald guy like maybe Rick Rule, who began buying gold in the year 2000, whose basis is a little less than it is today. It is not in my interest to liquidate gold, pay a substantial capital gains tax, and use the proceeds to buy gold tokens. They are not the same asset class, even if they had the same body of law around them, because my ascribed value would be reduced fairly substantially as a consequence of tax. We have learned that there is, by we, I mean Battle Bank has learned that at current gold prices, there is at least $50 billion of bullion holdings held by U.S. people in storage in types that we recognize. And a substantial amount of that is going to be frozen in physical metals as a consequence of depending on...
But this is where Rick Rule shifts the conversation to an opportunity that many investors completely overlook during precious metals bull markets, and that is the mining companies themselves. Because while most people focus entirely on the price of gold or silver, the companies producing those metals often experience an entirely different kind of upside. To understand why, you have to look at how mining businesses are valued. Wall Street analysts and institutional investors typically build their financial models using conservative assumptions for commodity prices. They estimate future revenue, operating margins, and long-term profitability based on what they believe are sustainable prices for metals like gold and silver. These assumptions then determine how the market values the company today. But here's where the opportunity appears. In many cases, those models are based on price forecasts that are far lower than the actual prices being realized in the market. Rick Rule points out that many analysts have been valuing mining companies using assumptions around $3,500 gold and roughly $45 silver. Those numbers are used to calculate expected earnings, future cash flow, and the overall value of the companies. Now imagine what happens if the actual market prices exceed those assumptions. If a mining company is valued based on selling silver at $45, but the market price rises significantly above that level, the company's real earnings can come in far higher than analysts predicted. When those higher profits start appearing in financial results, the market is often forced to revalue the company. Investors suddenly realize the business is generating far more cash than originally expected. This creates what Rick Rule describes as a valuation surprise. Even if the price of gold or silver simply holds steady for a period of time, mining companies can still rise dramatically as their true profitability becomes clearer. When analysts update their models and recalculate future cash flows using higher metal prices, the theoretical value of those companies can increase substantially. In other words, the metals themselves do not always need to skyrocket for mining equities to deliver powerful returns. If gold and silver remain strong while production costs stay relatively stable, the margins for producers expand quickly. That expanded profitability can push mining stocks significantly higher, even during periods when the metal prices appear to be moving sideways. And this dynamic is one of the reasons experienced resource investors pay such close attention to mining equities during the early stages of precious metals bull markets. Because while the broader public is still waiting for dramatic price explosions in gold and silver, the companies producing those metals can quietly begin delivering extraordinary returns as the market slowly catches up to the new reality.
Our bank is, in a sense, an old-fashioned bank. Our regulators suggest that a well-capital bank has equity at 7% of total assets, which is to say employs 90% plus leverage. Your bank, Battle Bank, is run by two old guys, and we think 10 is a better number than 7, which is to say we will be, by conventional standards, under-leveraged. The second thing is that interest rates or deposit interest rates are just one of the costs that banks face. A different cost is facilities. Battle Bank is branchless. Our competitors lose, on average, 150 basis points of their credit spread by having a branch system. We don't have a branch system. There are some depositors for whom not having a branch system means that we won't get their business. We will only be able to attract people for whom this is our branch. I realize that dumb people need a bank, but they don't need Battle Bank. The consequence of that is that while the interest that we pay is higher, our operating expenses will be lower. The third thing is that we will not, as lenders, try to do all things for all people. Some of our banking competitors have come to believe that they're competent in 1,000 industries. And once every 10 years, they prove just how wrong that is. There are certain things that Battle Bank has done, or the people behind Battle Bank have done for a very long time. Certain industries we understand. Oil and gas, publishing, precious metals. We will limit ourselves to asset classes where we understand the value of the collateral. And then the fourth variable, which is customer acquisition costs. Most banks spend a fortune, I'll just say it, lying to you. They spend a fortune on advertising. They spend a fortune on devious deposit products.
Another critical detail Rick Rule highlights is the enormous disconnect between how the silver market is currently being priced and the assumptions that many analysts are still using in their forecasts. This disconnect may not sound dramatic at first, but it can have extremely powerful consequences once the market begins adjusting to reality. Most financial institutions rely on long-term commodity price assumptions when they analyze mining companies or evaluate the future of the silver industry. These numbers are meant to represent what analysts believe is a sustainable average price for silver over time. According to Rick Rule, many of the major financial models used by Wall Street and Bay Street analysts are still built around silver prices of roughly $45 per ounce. At first glance, that might seem reasonable. But when you consider the forces building inside the silver market, those assumptions may already be far too conservative. If silver begins trading significantly above those levels, the entire framework used to value the industry could suddenly look outdated. This is where things can start to accelerate quickly. Imagine a scenario where silver rises well beyond those forecasts. Suddenly, every mining company that was valued using $45 silver begins generating profits based on much higher prices. Revenue jumps, margins expand, and the cash flow flowing into those companies increases dramatically. Investors who were previously skeptical begin realizing that the industry's earning power has been severely underestimated. When that realization spreads across the market, analysts are forced to revise their models. Net present value calculations change, long-term production forecasts become more profitable, and investors start reevaluating the entire sector. In many cases, this leads to rapid repricing across mining stocks as the market adjusts to the new price environment. And here's where the effect becomes even more powerful. Because once analysts raise their price assumptions, the projected value of silver deposits still sitting in the ground also increases. Projects that once looked marginal suddenly become profitable. Exploration companies that previously struggled to attract capital can suddenly find themselves holding extremely valuable assets. In other words, when silver moves far beyond the assumptions used by financial institutions, it doesn't just lift the price of the metal itself, it can transform the entire economics of the industry. Companies that once appeared average can suddenly look incredibly profitable, and projects that seemed insignificant can become strategic assets. This is why experienced resource investors pay close attention to the assumptions buried inside financial models. Because when the market price of a commodity begins drifting far above those assumptions, it often signals that a major revaluation phase could be approaching for the entire sector.
At Battle Bank, we have developed a waiting list of 22,000 people who want to do business with us. They want to do business with us enough that they've told us, after having reviewed the menu of goods and services that we offer, which of the services that they'd like to access. And this has occurred at effectively zero cost to us, with the exception of wear and tear on my carcass. So if you look at the fact that we pay higher interest rates, that's offset by the fact that we have lower facilities cost, zero customer acquisition cost, that we don't engage in time spreads. In other words, we don't make long-term fixed rate loans that we fund in the overnight. In other words, we're not going to go the way of Silicon Valley Bank. It does something else too. And this is really important, Dunnigan. I'm glad this question was asked. At Frank's prior bank, Everbank, they really pioneered honest banking. Rather than having 15 deposit products designed to hoodwink the customer, many of which paid no interest, they had one simple cash account. You could write checks on it, and it paid good interest. They also enabled savers to save money in 28 currencies rather than just one. And what happened, and this is subtle but important, what happened was that the relationship between the bank and their depositors was ecstatic, as opposed to mutinous at most banks. And when the refinancing boom of the early part of the decade of the year 2000 to 2010 happened, Everbank became one of the largest mortgage originators in the U.S. without having to advertise, because their depositors had a relationship with the bank and said, "Will you give us the mortgage?" And my hope, my belief, is that by treating our depositors fairly, we'll get some of the rest of their banking business without having to compete with other banks for them. In other words, I believe that the fact that we, as an example, pay interest on savings where our competitors don't.
When you step back and look at everything we've discussed so far, the picture that begins to emerge is far bigger than a simple commodity rally. What Rick Rule is describing isn't just a short-term price move in gold or silver. It's the early stage of a structural shift in how the world thinks about money, savings, and financial security. For years, the global economy has been running on an expanding foundation of debt. Governments borrow more to sustain growth. Central banks intervene to stabilize markets, and financial assets continue rising in value as liquidity flows through the system. But every system built on expanding credit eventually reaches a point where confidence begins to waver. When investors start questioning the long-term purchasing power of currencies, they naturally begin searching for assets that cannot be printed or manipulated in the same way. That's the role precious metals have played throughout history, not as speculative trades, but as monetary anchors during periods of financial uncertainty. Gold has already begun responding to that shift as central banks and institutional players quietly accumulate it. But if history is any guide, silver rarely stays quiet once that process accelerates. Silver's market is dramatically smaller than gold's, which means it doesn't take nearly as much capital to move the price. When investor demand begins flowing into silver in a serious way, the supply available on the market can tighten very quickly. Industrial demand continues to grow, investment demand begins to rise, and suddenly the balance between supply and demand can shift in ways that surprise even seasoned market participants. This is why the later stages of precious metals, bull markets, often feel so explosive. At first, the move is quiet, almost unnoticed. A small group of investors recognize the macroeconomic trends and begin positioning themselves early. But once the broader investment world finally understands what is happening, capital begins flooding into a market that simply isn't large enough to absorb it smoothly. And when that moment arrives, the price adjustments can be dramatic. The forces driving gold and silver today are not temporary headlines or short-lived economic fears. They are structural forces tied to debt, currency stability, global reserves, and the long-term purchasing power of money itself. If those forces continue strengthening, the precious metals market may still be in the early chapters of a much larger story, which is why some analysts are beginning to revisit price targets that once sounded impossible. A $1,000 silver price sounds extreme today, just like $50 silver once sounded impossible decades ago. But markets have a way of surprising people when long-term monetary trends collide with limited physical supply. And the investors who tend to benefit the most are usually the ones who recognize the shift early, long before the headlines caught up with reality. If you have found this breakdown helpful and you want to stay ahead of major developments in the silver market, make sure you subscribe to the channel so you never miss the next discussion. And as always, remember that this video is for informational purposes only and is not financial advice. Always speak with a qualified financial professional before making any investment decisions.
COMEX doesn't fail. Listen, the GATA guys are good friends of mine. I enjoy them. I enjoy the fact that they enjoy debate, often with me. I don't believe that markets have been artificially suppressed in the long term. Markets are manipulated all the time. Markets as big as the Treasury market are manipulated. Traders manipulate markets. That's what they do. This spoofing that you've seen will never quit, ever. But the idea that there was a 40-year-long conspiracy to depress the price of gold while the U.S. dollar was strong flies in the face of arithmetic. It's convenient for people who made the wrong bet psychologically, but it's silly. GATA has been reduced in importance in terms of the public debate around the gold bugs because the gold price has gone up. You don't need to blame anybody. I mean, the gold price as recently as the year 2000 was at $256 an ounce. Now it's at $5,000. Some suppression. Now, as to COMEX, this fantasy that the sort of Reddit crowd had that they were going to teach J.P. Morgan Chase a lesson by squeezing physical supplies suggests that these people don't know very much about the law. The exchange is owned by the exchange members. You saw imbalances in the tin market. What did the exchange do? They declared force majeure and they cash settled.
And nickel, they rolled back trades. Yeah.
Correct. The idea that you're going to catch J.P. Morgan or Loeb or Conti or Cargill or any of these guys short is nil. You might face them into an ugly cash settlement, but the idea that they would have to go to the market and buy physical silver at any fiat price, that isn't the way it works. You know, I forget who it was, but they said there's a club and you ain't in it.
Silver has always been the metal that surprises people the most. It spends years moving quietly, ignored by the financial world, dismissed as an afterthought next to gold. But when the conditions are right, when the pressures inside the global financial system finally begin to release, silver has a long history of moving in ways that very few investors are prepared for. Rick Rule's core message is that the rally we've already seen in gold and silver did not begin because the public suddenly rushed into the market. It began because deeper structural forces started pushing capital toward real assets. Foreign central banks began diversifying away from the U.S. dollar. Governments around the world continued expanding debt and deficits. And slowly, almost quietly, the foundations of the monetary system began shifting beneath the surface. What makes this moment so fascinating is that the majority of investors still haven't fully entered the precious metals trade. Gold ownership remains extremely small relative to global portfolios. Silver ownership is even smaller. That means the early stages of this move have largely occurred without the participation of the broader investing public. History shows that precious metals bull markets tend to unfold in phases. The first phase is driven by a small group of investors who recognize the macroeconomic pressures building inside the system. The second phase begins when institutional capital starts adjusting its allocations. But the final phase is where the real acceleration happens. That is when the broader public finally recognizes the trend and capital begins flooding into a relatively small market. And silver sits right at the center of that potential explosion, because the silver market is tiny compared to most financial markets. When investment demand rises while industrial demand continues growing, the available supply can tighten extremely quickly. That is why silver has historically delivered some of the most dramatic price moves in the entire commodity sector. Rick Rule also highlights something many investors overlook. Even if the price of gold or silver pauses for a period of time, the companies producing these metals may still have enormous upside. Many mining valuations are still based on conservative metal price assumptions. If real prices continue rising beyond those forecasts, profits expand and companies can be revalued dramatically higher. When you combine all of these forces together, the picture becomes much clearer. Central banks accumulating gold, governments struggling with unsustainable debt, investors slowly rediscovering the importance of real assets, and a silver market that remains historically small compared to the amount of capital that could eventually enter it. That is why some investors believe the next phase of the precious metals cycle could be far more dramatic than anything we have seen so far. Price targets that once sounded unrealistic may begin to look more plausible as the monetary environment continues evolving. Whether silver ultimately reaches extreme levels like $1,000 or not, the forces pushing the metal higher are very real, and they are strengthening, not fading. The key takeaway from Rick Rule's perspective is simple. Precious metals are not just another trade. They are a response to the changing structure of the global financial system. And the investors who understand that shift early are often the ones best positioned before the biggest moves unfold. If you want to stay ahead of the biggest developments in the silver market, make sure you subscribe to the channel so you don't miss the next discussion. And remember, this video is for informational purposes only and is not financial advice. So always speak with a qualified financial professional before making any investment decisions.